Welcome to today's video. I'm going to be going through the update on Ring Energy and sort of what's happened since I've last spoke about the company. Give you some quick updates. Firstly, we'll just start off with the obvious one. The stock has obviously run up. It's gone from about 70 cents when I last talked about it, 75 cents. Now it's about $1.05. So I think that's a fairly large increase, about 50% in a couple months. It's obviously still too early to tell with this one. However, I will be just going through some updates and the reasoning behind that. And one of the main things that have been causing significant selling pressure, other than just the fact that most oil companies have been going down because of the fact that oil prices are suppressed and they've got a lot of debt, is the fact that actually they had this one massive shareholder that just caused a massive overhang, which was Warburg Pincus. And this company, or investment fund, shall I say, used to own a 30% stake in the business, and that had basically now been trimmed to 0%. So as you can think, that's massive selling pressure over that year span of time. I mean, to sell 30% of the entire float within that period is obviously going to have a huge impact. It's been confirmed recently that the position has been closed. It's 0% now, and that was part of my rationale for waiting slightly, and hence you'll see in the other video the title was actually I'm waiting to buy upon that sort of confirmation that they've exited their position. As you can see, it's done quite well in the short term. No, I'm not too bothered about the short term as such, but that was sort of my rationale behind it. And you might be thinking, well, why are they selling 30% if they know it's going to go down anyway? And this is the thing in the stock market. I see a lot of people selling for irrational reasons or reasons that aren't fundamental to the business. So in this particular case, Warburg Pincus have actually started transitioning their fund to be more ESG based. As a result, oil companies such as Ring Energy have been getting disposed of in the fund. You can see this if you just study their website a bit, and that will sort of, you can jump to conclusions there and sort of get a real sense of what's going on. Nothing concerned with the business. I mean, if you look through their other holdings as well, you'll notice that trend. In terms of another piece of important news has been the CFO has left. And if you see my earlier videos or just sort of my own thinking on this has always been that there's a few things that I really like about this business, but there's also a few things that I think I need to be careful of. And one of these has always been the debt levels. And the CFO having just left, and this was also quite abrupt, to me is a massive, I don't want to call it red flag because it's not quite there yet, but it's definitely something I'm taking into account, or it's not something for me to warrant selling my position necessarily. But what's effectively happened is, from a finance perspective, is the company has been cutting down debt. So since 2022, they've started talking about, oh, we're going to offload debt. We're going to keep reducing our debt, and that's going to be our focus. They didn't say full focus, but they did say that was definitely going to be a focus for them. Keep in mind, this was 3 years ago. Since then, their debt has increased. Now, is that bad? No, not necessarily. The acquisitions they have made have turned out pretty well in general. I can't fault the acquisitions there. But what I am cautious of is, where do you stop? And in 2025, I think they've really started to understand that, where it's like it is now been classed as their full focus. That's sort of the way they've described it. And to me, to come at a time where you've said it's a full focus for you, to then buy another investment then buy another company. Yes, it's a much smaller acquisition, and yes, there were true synergies where they're probably going to save about 10 million per year. So just that saving alone will pay the deal off in itself in 5 years. For those of you who don't know, they did an acquisition recently after they said it was full focus. And actually what happened is that acquisition was for $50 million, so much smaller than their other acquisitions, 150 plus million, right? Or $100 million range. So not too bothered about that. But what is my concern here is that, yes, it was a great deal when you sort of run the numbers. That's not what this video is for. When you look at sort of the fact that the people working on those facilities are right next door to where Ring operates, so they had a huge manpower saving there, and that's sort of where you can get to like a $1 million a year savings. calculation. So huge increase in profitability there. But to still make that acquisition when you know the balance sheet isn't, the business isn't going bankrupt anytime soon, but you've committed to paying down debt, you've committed to sort of reducing that load, particularly as oil prices are suppressed, and to still go ahead and make an acquisition isn't necessarily great. And yes, I do agree that the acquisition itself is a great deal from a pure finance perspective, from the pure numbers perspective. So I thought, looking at that, I thought, okay, I can see the reasoning behind it. Fair enough. I can kind of get on board with that, because you know what, that's a one-off scenario. That's sort of like a freak, not a freak acquisition, but almost, it's very rare that you get an acquisition where it's actually a neighboring facility where you know there's a chance to save a heck of a lot of money, just because the fact that you're not going to need as many people to run both as you are to run them separately. So I thought, okay, but then I see the fact that the CFO leaves quite abruptly as well. So his termination or resignation was effective immediate, which is always, for better opportunities, that's always corporate for something's going on. And to me, it just sort of sparks a thought where it's like, well, we know we're at this time where debt repayment is crucial. We know they've already made a slight acquisition. Now the CFO has left, and because it's effective immediate, we can interpret that there's likely been some sort of, not argument, but potentially differing in beliefs. I don't think that there probably was an argument, but there was definitely probably a strong decision to part ways because they had different perspectives. And my thinking is could likely be to do with acquisitions. So for me, I'm very cautious of this. Should there be massive acquisitions ongoing, particularly where debt hasn't been reduced enough, I will probably be looking to exit my position, just because it's something I'm not comfortable with, even though the business is still going to be very profitable, likely into sort of going further beyond, particularly as oil prices have started recovering from that very low of like $55. It's gone up slightly now to like this low to mid 60s. So whilst I don't think Ring Energy would go bankrupt at these levels, it's certainly not anywhere sort of until you get to like the $45 range for a long period of time, nor do I think we're going there. I just am not comfortable with the fact that management sort of, if this were to happen again, I'm not sure, if they were to say one thing and do another. And to me, the fact that in their 2022 earnings calls, you can hear them talking about reducing debt. And when you see what's actually gone on, it's just sort of piled up. I think they are keen to expand, and I can see that, and I can see that they've grown tremendously. But to me, I need to know that management have that boundary to stop there. And you might think, well, David, you're taking this a bit too seriously. You know, of course, the business has got to grow. When else are you going to buy when oil prices are low and you get all these great bargains? I understand. My concern lies with the fact that there has been a similar business that they operated. So Paul McKinney, he was one of the directors of Yuma Energy, where he previously worked for a short stint for 2 years. And this company is now bankrupt, and for very much the same reasons, in the sense that in fairness to Ring management, they have done multiple small acquisitions, which is a heck of a lot better than just merging two massive companies and taking on a ton of debt like Yuma Energy did at the time. But that ultimately led them to be in a heavy debt position, and then they spent a ton of money to develop those wells to then try and pump out cash flow. But obviously, when you have a ton of debt and oil prices in 2019 collapse, it's not very good timing, ultimately leading them to file bankruptcy. Now, in fairness, the CEO at the time was different to our current CEO. However, our CEO was still one of the directors of operations. So to me, you were still part of that circle. Now, could you argue that yes, he's learned his lessons? Well, I'm not sure, because I can't tell from an outsider looking in, and that's part of my concern here. And that's why I have to solely base it on the actions that are being taken. And that's sort of hence my reasoning behind being cautious here in this particular situation. I can see that, there definitely have been changes in the sense that compared to the Yuma bankruptcy, Paul McKinney is running this from start to finish, so there is no, or from a good position at least, not from a sinking ship. So I'll give him that. That's a fair sort of criticism you can make to my thinking, which is completely fair. Secondly, I can see that actually they have learned in the sense they're not making one massive acquisition and hoping it just, does really well for them. Rather, it's small continuous acquisitions where they can add value in specific areas, and that's namely just by improving the technology used when drilling, taking advantage of the close proximity to one another, etc., to save costs. So that's again an improvement. I can see the fact though actually when oil prices have fallen, they've scaled back production very aggressively. They've scaled back spending very aggressively. So again, that's always positive to see. However, I am still conscious that that risk is still there, and I don't want to get caught offside by it. Particularly because this business is in the commodity space in particular, that's something I have to be really cautious of, because commodities are known for just destroying investor money, in the sense that there is so many ways to die in this space is something I've found. It could just be temporary oil prices because of some random news that goes off that just plummet. It could be OPEC agree to suppress oil prices to wipe out their competitors for further long-term gain. It's so many things that you just wouldn't be able to predict. It could be banks are struggling and then they have to tighten their lending criteria, and then that causes a whole chain to go off, and potentially Ring's not the first one to go on to get hit in that chain, but then someone else could, and then that could see a lot of bankruptcies start going off in the oil space. There's so many ways to die in this space, so it's best just to be cautious. I want a bit more security. I can completely understand where Paul McKinney wants to go, because the acquisitions do make a lot of sense. You can get very high returns on capital. We're talking mid-teens and if not higher returns on capital, based on the way they structure with deferred payments, debt, and the fact that they're able to increase the earnings as well as reinvest into the wells at much higher rates, actually, probably arguably even 20-30% in a lot of cases when just reinvesting in simply to the wells. So there is merit behind it, but it's just something I need to be cautious of. So that's sort of my thinking behind it. If I see any news of an acquisition, I think that would be it for me, really. It'd have to be something that changes my mind, or it's structured in a way where the balance sheet is still okay. I don't think diluting makes sense at these valuations, to be honest, because Ring itself is already so cheap, in my opinion. But that's generally my thought process behind this. Hope you found it useful. Let me know what you think.